In October 1973, the price of crude oil tripled in weeks, and economists are still arguing about why it actually happened. The standard story is clean. OPEC embargo, supply shock, prices spike, inflation follows. Cause and effect. But here's the trick, that's not where the real money moved. The embargo did cut supply by about 5%. Significant, yes, but oil prices didn't triple because of 5% scarcity. They tripled because of what traders and governments did with the fear of scarcity. Futures markets panic buying. Strategic reserves, the financial architecture, amplified a supply pinch into a full economic seizure. Before October 1973, crude cost about $3 a barrel. By December, it hit $12. Governments panicked. They released strategic petroleum reserves, but not enough to stabilize prices, just enough to signal panic to markets. Oil companies, seeing prices climb, slowed production to maximize per barrel revenue. Refineries operated below capacity. The shortage became self-inflicted. Manufacturing collapsed because energy costs spiked unpredictably. A car maker couldn't budget for production if gasoline prices doubled every quarter. Wages stagnated while inflation ate purchasing power. Unemployment rose. This wasn't just supply and demand, it was structural shock meeting weak institutional shock absorbers. Central banks didn't have the tools to separate price shocks from demand shocks. The real culprit, financialization. Oil wasn't just a commodity anymore, it was a speculative asset. Traders with no intention of using the oil were buying futures contracts, betting prices would climb. This inflated demand on paper. The physical shortage was real but modest. The financial shortage, credit markets freezing because banks couldn't predict costs, was catastrophic. By 1975, inflation in the US hit 12%. Unemployment hit 9%, both rising simultaneously. Stagflation. The textbook said that couldn't happen, but it did because the supply shock was real and monetary policy couldn't fix it without crushing demand entirely. The money didn't vanish, it just moved. From consumers to oil producers, from manufacturers to creditors, from workers to asset holders. What matters now? Supply chains amplify shocks through financial markets before they hit the real economy. A 5% shortage becomes a 300% price spike because speculators, governments, and corporations all react simultaneously. One disruption triggers cascading decisions, each rational individually, collectively catastrophic. The 1970s oil crisis wasn't just about geology or geopolitics. It was about how information, credit, and expectations move faster than physical goods. Understanding that difference between the shortage and the panic is the difference between seeing a supply chain as a logistics problem and seeing it as a financial system. This video is for educational and informational purposes only and is not financial advice. Always do your own research. Subscribe for deep dives into the hidden financial mechanics that move the world. Every week we follow the money line by line. This video is for educational and informational purposes only and is not financial advice. Always do your own research.